what's going on in the stock market. We had we had some bad earnings with tech stocks yesterday. We had Amazon, a lot of big tech stocks reporting. Let's look at that chart of stocks that are reporting yesterday. Okay. We had two things happen this week. We had the Fed talking on Wednesday. They basically raised the quarter, and everyone predicted that. And the stock market went up because, you see, Meta platforms. So Facebook had a really good earnings report. They spent less than expected their analysts were thinking they were getting out of control with their expenses. And now 3 months later, they're saying, we've turned a leaf, we're becoming more conservative, and we're cutting costs. So that made Meta go up 24%. But that's another example of a stock that went down to a PEG ratio of 1 and bounced when it was fairly valued. So let's look at other stocks that were reporting yesterday. We had Apple, we had Alphabet, Amazon, 3 big ones, and they all disappointed. So the stock market basically opened really low today, and it rallied back a little bit, but now it's going down. So let me see. Amazingly,
Apple seemed to weather their bad results pretty well, though.
That's pretty amazing. They're like one of the only large cap stocks that reported bad results. That there's 2.79%. That's pretty amazing. The interesting thing about Apple is I follow that like super closely because it's really important to my portfolio. The biggest things that I saw when they reported was they didn't have enough iPhones to sell because of the COVID problems on the fourth quarter in China. So they couldn't make the Pro models, the Max, 14 Pro, 14 Max. And there's people that say it's not demand destruction, it's people that don't upgrade to the 14 Pro will get it next 3 months from now, or this quarter, now that they have it. They don't buy an Android or a lower end iPhone, they'll just wait a little bit for it to be in stock. So they might have a pent up demand and have a better quarter this quarter because of that. The other thing is they said that they bypassed 2 billion devices in activated around the world, and their services are doing really good. So they have 20 billion in services, and they're expanding in India, Indonesia, and Brazil. So those are 3 different markets that are going to be growth places for them. But that services revenue stream is like really important because it basically costs them almost nothing, and they take in money for services. Let me see. So that's probably why they're weathering it better than the other stocks, like Amazon and Google. They're both down like 3 to 6%. Okay, so we knew it would be pretty volatile week, depending on what the earnings were. So right now we're overbought in the stock market. So let's look at our stochastics. We do this every now and then. Let's look at the S&P. We noticed when it broke out of this downtrend, we had a pretty good momentum going into this, and we broke out of this downtrend. What's going on in the stock market? We had some bad earnings with tech stocks yesterday. We had Amazon, a lot of big tech stocks reporting. Let's look at that chart of stocks that are reporting yesterday. Okay. We had 2 things happen this week. We had the Fed talking on Wednesday. They basically raised the quarter, and everyone predicted that. And the stock market went up because, you see, Meta platforms. So Facebook had a really good earnings report. They spent less than expected on. Analysts were thinking they were getting out of control with their expenses, and now they're 3 months later. They're saying we've turned a leaf. We're becoming more conservative, and we're cutting costs. So that made Meta go up 24%. But that's another example of a stock that went down to a PEG ratio of 1 and bounced when it was fairly valued. So let's look at other stocks that were reporting yesterday. We had Apple, we had Alphabet, Amazon, 3 big ones, and they all disappointed. So the stock market basically opened really low today, and it rallied back a little bit, but now it's going down. So let me see. Amazingly,
Apple seemed to weather their bad results pretty well, though.
That's pretty amazing. They're like one of the only large cap stocks that reported bad results. That there's 2.79%. That's pretty amazing. The interesting thing about Apple is I follow that like super closely because it's really important to my portfolio. The biggest things that I saw when they reported was they didn't have enough iPhones to sell because of the COVID problems on the fourth quarter in China. So they couldn't make the Pro models, the Max, 14 Pro, 14 Max. And there's people that say it's not demand destruction. It's people that don't upgrade to the 14 Pro will get it next 3 months from now or this quarter, now that they have it. They don't buy an Android or a lower end iPhone. They'll just wait a little bit for it to be in stock. So they might have a pent-up demand and have a better quarter this quarter because of that. The other thing is they said that they've bypassed 2 billion devices in activated around the world, and their services are doing really good. So they have 20 billion in services, and they're expanding in India, Indonesia, and Brazil. So those are 3 different markets that are going to be growth places for them. But that services revenue stream is like really important because it basically costs them almost nothing, and they take in money for services. You see, so that's probably why they're weathering it better than the other stocks, like Amazon and Google. They're both down like 3 to 6%. Okay, so we knew it would be pretty volatile week, depending on what the earnings were. So right now we're overbought in the stock market. So let's look at our stochastics. We do this every now and then. Let's look at the S&P. We noticed when it broke out of this downtrend, we had a pretty good momentum going into this, and we broke out of this downtrend. It seems as though for the next year, if we're doing our planning here, in a recessionary environment, a lot of these companies are saying there's cautious. The economy, like Apple said, that the economy is not going to be so great, and it's a challenging environment. And so that means most of the quality stocks will basically, I'm thinking, mark time this year until we get the interest rates under control. So let me see. So I think it's really important to see that there are good quality stocks that are down 20 to 50% at times, and it's only whenever you have this period of time where we're kind of at we're not going to be going up anytime soon. It's going to be sideways for quite a while. What I did was I put together, we do this every three months or so, every time the mutual funds update their holdings. What I did was I went through the largest mutual funds and look at their top 10 holdings. And the reason I do this is, these mutual funds and hedge funds, they basically have an unlimited source of money to research this, and they can actually talk to presidents of the company, CEOs. So they have a really good understanding of what a good buy and hold stock is. And, we've been following these stocks these mutual funds for a couple of years now, and if they hold the same stock, over a period of 10, 20 years, there's a very good chance that, that's a quality stock that you might want to put a little bit towards in your growth portfolio, especially if it's down a lot. So we see, what I did was I kind of mapped out the changes in the portfolio since November of last year. So that was 3 months or so. And the ones that are red are the ones that are taken away or reduced. The ones that are yellow are newer holdings or increased their percentage. And I didn't see a real really good there wasn't the same changes made across all the different mutual funds, but I thought it was interesting to note some of the changes that were made by Fidelity. They still have basically a lot of the big tech stocks as their number one holdings, and that hasn't changed. I think Contrafund, we noticed, like last year, we were saying Facebook was the largest part of their portfolio. It's probably down. They probably didn't sell any, because if it's still 6%, I mean, if it went down 50%, then certainly they would have had to buy more to keep it at that 6.4% level. So hold on for a second. Okay. Right. So so the things let's look at the ones that have changed. United Health, they increased that percentage. There's a new one, NEE. It's an energy company, and we can look into that maybe another day. They do renewable energy, and they have a big backlog of work. But it's interesting that they would have that in their top holding of large cap stocks. So I know Josh Brown on CNBC, this is like one of his favorite holdings. So I'll look at that next time, but not this time. But Lilly is actually in a top holding. This is the first time they had Lilly as a holding. Remember 2 weeks ago we saw Lilly was growing 20%, but their PEG ratio is 1.5, so it's a little pricey. But if they have some of their drugs could be the best-selling drugs of all time. Look at this one right here. Vanguard Prime Cap Investor has Eli Lilly as their top holding of all the large cap stocks, which is pretty amazing. So I like to look at this, because if Lilly drops based on some bad news, or like maybe a drug didn't work out too well, that could be, and it goes down to a PEG ratio of 1. You might want to look at that for a balanced part of your portfolio, where you put a little bit in the drug companies. In NVIDIA, they started buying NVIDIA because it was down 1/3 of what it was before. We saw NVIDIA in other Fidelity holdings. And so my point with this exercise is, if you're at all interested in growth and having a core holding of companies that are growing around 5 to 10% consistently over time, you might want to consider looking at some of these stocks that the top mutual funds hold. And if you look at the amount that these companies are down, a lot of them are down 30, 50%. I guess if you don't have any of these right now in your portfolio, it could be a good time to start paper trading and or buying a little bit at a time, because this is a volatile environment. But if these companies are still holding them, or these mutual funds are still holding them, there might be something to it. If we look at my portfolio, I base my portfolio on when I started doing this, investing. I copied, what these. You see, hold on. Okay, so if you see my holdings, it's very, very similar to these mutual funds. I bought and held. My biggest problem is I have a couple outsized positions, but if you're establishing something, you're going to buy and hold, for long-term growth, you might want to look at, some of the ones that are in these top holdings and see if it makes sense for you. I always try to buy these kind of long-term holding stocks whenever they drop a lot or their PEG ratio is 1 or less. And then that's a good time that you're buying something that's fairly valued if it's a PEG ratio of 1. So, okay, that's just, that was a good exercise to do every 3 months or so when they update these holdings. Any questions on any of that? All right. There was some, Joe was asking like two weeks ago, he says, what, have you sold Amazon? And he was asking me what changes I made to my portfolio. The biggest change that I made at the beginning of last year, Amazon has a PE of like 70, and its PEG ratio is pretty high, and so I trimmed this. I eliminated. Well, we used a bigger position, but I trimmed it because we were getting into an environment where if you get into a recessionary environment, the higher PE ratios, the higher PEG ratios are don't do as well. And so whenever Nike was dropping, I think I was talking about this I nibbled at that. I doubled my position when it went down to 80. And I bought a little bit more of Eli Lilly because it was, I'm trying to get a diversified portfolio. So I bought a little bit more healthcare. So over time in my portfolio, what I'm trying to do is I'm trying to get more conservative. I'm trying to get more dividend-paying stocks and less risk. So over time, I'm kind of exiting positions that are a little bit more risky, like Amazon, that have higher PEG ratios, and moving into more dividend-paying stocks and more consistent, and diversifying into different sectors. So that's so also I bought Devon Energy. It's yielding 9% or around 99%, and that's part of my diversification. I'm trying to get move from my huge tech positions to more diversified income-generating companies. Very small positions. I have. I started with this AGNC. It's a REIT, a mortgage REIT that pays around 15% dividend. It's a small position. I bought that whenever there was a guy used to run a Fidelity, Bill Gross, I think it is. No, Bill Gross. He said he was. He thought that was a good REIT. And if a bond guy is saying that, I'm like, okay, well, who better to say it's a decent thing to invest in? And I started a very small position in T-Mobile because we were talking about it, how it's growing around 20-25% when AT&T and Verizon are losing market share. So I'm hoping T-Mobile goes down, and then I'll put a little bit more position in. ChargePoint and Blink are two positions that they're starter positions. Like, I'm hoping I buy some. This is like the future of energy, perhaps. If we become in 20 years, if the energy infrastructure changes to electrical vehicles and we're getting away from oil. Let me see. ChargePoint is actually these aren't making money right now. They're not making money, but ChargePoint is the largest charging company in America, so it could easily be a takeout candidate for a large oil company that wants to put one of these in all their stations. I don't know, but it's an example of investing, knowing that the total addressable market is big, but right now they're losing money, and they could go bankrupt. That's why I don't put a whole lot into them, and they're a very small percentage of the portfolio. So, Joe, you wonder what changes I made, but those were it, and they're not that much. But anyways, let's go back to any questions on that? Any questions on my holdings at all? Okay. Let's go back to some...
Amazon, just one comment. Amazon is bouncing back a bit. So it's finally going up. But
okay, let's look at Amazon today.
I don't know.
AMZN. Okay, so they actually beat earnings today. But they guided light. So they're down 5%. They beat earnings, but they said it's going to be challenging going forward. Every company is going to have... If you're smart, you basically say, we don't know what's going to happen next, because we're going into maybe a recessionary environment where the economy contracts, maybe because of these interest rate hikes, and companies have to cover their butt and say, if they say we're going to be doing good like they think they will, and then the consumer stops spending or whatever happens, they have to make sure that they're very conservative with their projections of what they're going to do in the next year. Some companies don't even give projections. Apple used to give, detailed, projections of what they're going to be selling, but now they don't even do that anymore, because the environment. I think every one of these big companies say the macro environment, the economy and everything, that's affecting their sales and affecting their company. And it's even Apple yesterday said that the economy might makes our company not as predictable, and as so. But they're down. They had bad guidance. So bad guidance is probably worse than not making your numbers for a company, because the stock market is forward looking. There's a lot of we know that the next 2-3 months or so in the stock market is going to be like challenging. Let's look at our everyone on TV. Everyone is saying that the first half of the year is going to be like flat to negative earnings. So what the stock market does in general, whenever they reward or punish stocks, is they look towards what's going to happen next year. Like, is Apple going to recover and start selling again, or is at what time? They look forward earnings. But if the company projects that they're going to be challenged for the next earnings report, then that just makes the stock go down. That's just the way it works. So let's look at let's look at our talking points here. Okay, so oil is actually down 10% since last week. So we know that whenever the economy is getting better around the world, the demand for oil goes up. We have China reopening. That means more oil is used in China, and the supply goes down, and that means the price goes down. So, China reopening. If China has a demand for oil, that means the price of oil goes up because there's more supply than demand. Okay, more demand than supply. So we have, it's down 10%. So all the oil stocks, they felt that. We saw that there was, Iran says drone attacks target defense facility, and so a lot of times whenever you see the price of oil go down, I said this a couple weeks ago, I said, well, sometimes the Mideast countries manufacture a crisis, making the oil go back up again. So, like for instance, a tax on Saudi infrastructure or something, then the supply of oil goes down if there's an attack, and then the price goes up. So we're never going to figure that out. But for us, this is one of the biggest inputs for costs for every company we're following. So that's why we're following it. Inflation, it's getting better, and it's still, for the past 6 months, it's still about 2.3%, 2.5% if you average the inflation for the past 6 months, month to month. So, and the Fed on Wednesday said it was deflationary environment. Deflation, they basically said inflation is coming down, and that's why the stock market was rallying. But we look at, you see. All right, so this year, our game plan for this year is we're going to be flat to down for the first 6 months or so. And seeing that, I think a good plan would be to look at some of these, good quality holdings for the growth part of your portfolio, the core holdings that you never sell, you buy and just watch it. I don't know, everyone has a different percentage for that. Mine is like 80% of my portfolio is stocks that I'm buying and holding. And, look at that list of stocks that are quality growth, and put a small amount at a time into these, knowing that they'll probably go down 20%.
But you say you have 80% in stock. What about the other 20%?
Let me see. Well, these are like growth stocks, right? The 20%, I have like a 80-20, 20% dividend.
Oh, okay, dividend. But
yeah,
stock, right?
Again? Yeah, they're stocks. But what I meant to say was I have around 80% of my portfolio currently is in long-term holding growth stocks.
Oh, okay.
20% is stocks that are yielding 2 to 5 or more percent. And that's my plan for retiring. I'm moving towards maybe over time, every 2 or 3 years, I'll go down 10% in my growth, put 10% into my dividend yielding. And until I get to like 80% dividend and 20% growth. That's kind of, that's my current plan. And some professionals, everyone who says, oh, I'm going to retire at a certain time, they say take out, you quit working, you quit taking dividends, and you just put everything in a big ball of money and take out 4% a year forever, And that's what the professionals say, that's how you should retire. And yeah, you're short, that kind of works, but you won't have the quality of life that you will if you the way I'm doing it is I'm just not messing with my principal. The base, you don't really take 4% out each year, you add 2 or 3% every year, in dividends. And that's kind of...
Professionals say you take out 4%, we assume that the 4% of profits that you make, not 4% from principal.
Really? Well, you read any article on, retiring, and they say, can I retire with, $2 million, let's say. let's look at
they assume that 4% that you're going to make from your dividend or from some kind of profit, not from principal.
You sure about that? Yeah, let's look at this. This is our growth calculator, right? And this is starting investment. This is very useful. We can use $2 million, right? And let's say the growth rate is negative 0.04%. Okay, this is how I understand. I think it's the majority of people in the world retire this way. They get to a certain point in their life where I made it, $2 million. Then they withdraw 4% a year, and basically by the year, let's say you're 60 years old, right? 65, right? And you have 2 million. And what this does is it takes 4% away, and at the year end you have that much. And you do that every year until you get to 95. Let's look at what you have at 95. You have 500,000 remaining, right? So
I see your calculation, but I don't think that's what the professional talking about. I think they are talking about you put $2 million in there, and it's supposed to earn a minimum of 4%. And in a good year, it could earn 16%, but you only take out a minimum 4%. Wow, what you make with that $2 million.
Okay, so that I've always assumed there would be, you don't want to take any risk. Any risk. Once you've gotten your 2 million, you're just stopping and you're just going to be a miser the rest of your life, right? That's how I thought. But you're saying that, you can have 4%, let's say, in a CD, and then you have 80,000 in income, in this example, and over time that 80,000. In 20 years, that's going to buy you a banana. It's not going to have the purchasing power that it used to, So,
and that's increased with the inflation. That's not 4% forever. It's 4%. If inflation
with inflation, okay,
earning will go up.
Right. We'll have to add that into calculation sometime. But I guess whenever you get to a point, when you're 65. You can't take any risk, and maybe that I'm going to put it all in cash and put 4% in. I don't know, but I like the idea of, over the time that you're expected, you're towards retirement, you put less and less into risk and put things more into things that are guaranteed. So, I don't know. Good thing I'm not a financial advisor. So let me see. Let's look at some more. Any more questions on these calculations, or what to do when you get $2 million or whatever?
My question is, how do I get $2 million to begin with?
Slowly but surely.
Okay.
But the answer is that how do you get $2 million is you start with something, and over time. You just have to be patient and do your homework as you're growing your 4%, and you can actually use this, this calculator to say, oh, there it is right there. If I grow at 30% or whatever. The hard part is no stock grows 23% consistently. Then by the time you're 99, you'll have $1 million. All right, so. Sorry, I got off the track there. All right, so let's look at what sectors are going up and down today. Okay, you see. Energy is outperforming. Financial, utilities. Okay, for the past week or two, we've had a daily kind of what works, what doesn't work. And it's every day it's different. Like last week we were talking it was what worked last year doesn't work this year. Like all the tech stocks were good last year. No, were bad last year, and they were good this year. So right now we have everything's kind of doing bad. Oil and energy, healthcare. These are all stocks. These are all the industries that were outperforming last year, and are doing good this year. The things doing bad today: materials, real estate. All right, that didn't really tell us anything. Technology is like break even for today. That's surprising. With three big companies, Apple, Amazon, Google, all not meeting estimates. This should have been like tech bloodbath today, but it wasn't. For some reason, I don't know. Okay, so that's interesting.
Seems like they are saved by the bell. Huh? The increase, the slowdown of Fed rate increase. Save them.
I'm not sure why. It could be. I don't know. I'm not sure why, but I think it could be that the big tech stocks could be not as affected by other companies because of they have this like Apple has a good they have a good services business, and that's going to do good in good times and bad times. So that's pretty consistent. Maybe that's why. And the bigger companies don't have to borrow money, so higher interest rates doesn't affect them as much. Okay, let's review the Dan Niles and Leon Cooperman predictions. They both basically say we're going to be range bound for this year, and Dan Niles thinks we're going lower. So, if you're interested in buying any of those stocks, let me see. Any of these stocks in these mutual funds, assume that they're going to go down 20%, because Dan Niles thinks that's the fair value of the market right now. So that's S&P 3,000. So that's why you would dollar cost and not assume this is a bottom. They both, and if we trade right now, we've kind of broken out a little bit of this downtrend. But if we go sideways for the next year, like they think, then we're probably just we're going to be very volatile, and you have to understand it's going to be a year of this before we start going back to normal for the growth rates of these companies. All right, so DXY is up 1% this week. As soon as they had we had some non-farm payrolls rise, which was unexpected. That we were expecting 135, and it was 500. So the job market is just on fire right now. It's really good, and the reason the stocks are they started really bad out of the gate today was if the job market's really good, then the Fed has to keep raising rates. So, and the dollar went up immediately after that, and the Treasury rates went up too. And stocks hate whenever the treasuries go up. All right, now let's look at the Fear and Greed Index. We're at extreme greed now. So we look at we've been waiting for this for a while. We're at this point in our emotional chart. Extreme greed. There's a new paradigm, delusional, and we're overbought. So whenever all those things come together, we get a correction after that usually. And then people start saying, why is it going down? Oh, the Fed or whatever it is, they make their own things up. There are some people like Michael Burry today or this week he said sell, and he's predicting this huge capitulation. And you just have to have, you have to extract your emotions from the stock market and think, you can't let yourself be fearful whenever it's going down and everyone else is fearful. And there's capitulations, everyone's afraid. Just think of what's going to happen if we go down 20%. Are you ready? For the volatility? Are you ready for everyone on TV to say they're going to raise more interest rates and then make you confused? And for me, I'm just looking at the long-term holdings of these mutual funds. They're still holding the same stocks after 20 years. And you just have to see that this year is going to be kind of sideways to lower for growth for a lot of companies just because of the environment. All right, so we're extreme greed right now, and the VIX is saying that everyone's excited about the stock market. So they're not afraid anymore. So this maps out to the inverse correlation to the S&P. So there it is. Every time the S&P goes up, the VIX goes down. All right. So we've been following this story for a while. J&J, we've been following. They're a healthcare company. They make pharmaceuticals and medical supplies, etc. But they have this talcum powder lawsuit. They tried to put that in its own little investment vehicle or whatever it was, and just to limit the extent of damage for the company. And it turns out that they can't do that. And the reason I bring this up, this makes the reliability of this company go down. So the confidence that you have in a company to deliver earnings in the future, and whenever you have an intangible like this, the confidence in the company goes down. We can see this is 3M, going back to 2018. It's like a straight line down. They had a earplugs, and they were defective, and they sold it to the government, and there are all these claims against the company for selling defective earplugs. And that one product has this huge overhang on the company that their stock price went down like this. And you just have to think, if J&J has, some of their verdicts have been up to $3 billion, and if they have, an ongoing lawsuit problem with that, they could very easily mess their confidence. And that's why it's next to my. Here's what I'm seriously here real quick. Hold on, it'll be worth it. What I did was, next to my holdings, I have something called confidence, and the higher the confidence I have in a stock, the more I would put towards that stock. The lower the confidence, I would have like a lower amount in it. So what happens whenever you have a lawsuit like this, or you have like Google? I had 100% confidence in Google before the government filed a lawsuit against them. But once you have things piling on a company that are negative, you have to reduce your confidence level, and then you got to reduce your position size if it turns out to be something tangible that you can measure and look at the earnings. So for J&J, the confidence level went from 90%. They're a AAA company, AAA rated. That means they're probably one of the only ones left that are AAA rated. So for me, it went down from 90 to maybe 72, and because that could bankrupt the company. So you have to put less into those kind of stocks that might have, this black swan that could take out the company. Okay, so where were we? We're at J&J. Okay, So the company could go bankrupt because of that, but they're one of the best positioned to take on a lawsuit like this in the world. But for these kind of companies that have, this potential litigation, etc., I try to stay away from them. Okay, so Powell said that this is the Fed talked on Wednesday about interest rates. They raised the rates 25 basis points, and that was expected. So usually whenever you have an event, whether it's this earnings for a company or if it's the Fed doing something, if you run up into that, like we did, and they announced, yes, it is 25 basis points, so you buy in the rumor, you're selling a noose. But one thing he did say that this inflationary process is nourished. This is the first time he used the word disinflation. So that means the inflation is inflation is going down, and there's disinflationary forces, and that's why the stock market rallied. You see, so we have a strong job market, and the stronger the job market, the higher and longer the Fed will tighten. So that's like bottom line for this week. So we had earnings reports from Meta, all the big tech stocks this week, and Alphabet, Apple, and Amazon, they all disappointed. I don't know why Apple's up, but they basically missed because they couldn't produce enough iPhones in the fourth quarter. And Alphabet is I think they're being hurt by a reduction in economic activity, and that's probably going to happen the rest of this year. So you see, Amazon had great earnings, but they had soft guidance, and that'll make the price of the stock go down if you have forward-looking guidance that's not as good as expected. All right. So this article here talks about Apple's long-term positives outweigh rare earnings miss. And so, I already mentioned this. Growth in user spend and installation. So that means they had over 2 billion devices. Last year was like 1.5 billion. So the more it's like a snowball for Apple. The more devices they have out there being used, active devices, the more revenue they have in services. And they're trying to make people pay more and more in services. And I think one of their biggest products is Apple Pay. So they're trying to get people to pay and take a cut of every transaction. And but they're one of the only big tech stocks that didn't lay off people. So that was amazing, and that kind of shows that they're committed to all the projects they're working on. You see, Ford had a bad earnings report. They the story of Ford doesn't seem as good as it did a year ago, and GM actually had a really good report, and they went up a lot on their report. And one side note, Ford had to reduce their price of their sports cars due to Tesla's price cuts. So that was one of the greatest things about the company. They had a high price tag for they were making money on their EVs, but now if they have to match their competition, it's not so good. So I looked at their earnings, estimates, and so it says 5% from here to next year, and then 10% the year after. So let's say it's growing at 7% in the middle. So that means, and their PE is 7, so they're fairly valued. They're only growing at 7%, and they're a 4.5% dividend. That's not a good risk reward, and it used like the numbers were much better last year, but now it seems like there's competition. They're reducing the price of their product, and it's not as compelling as it used to be. And they missed it, and they missed their earnings, and they lost money this quarter. So it's becoming inconsistent, and it's only growing at 7%. So it's not as compelling as it used to be. I compared that with here's Ford's chart. You can see it's stuck in this sideways pattern right now. So most likely, until they get the growth up more than 7%, it's going to be sideways this year. So we can follow this. This is the time it'll hit the top of the channel and it'll go down to here. So it doesn't seem very exciting. I contrasted that with GM, just to compare two stocks in the same industry with the same kind of vehicles. So GM is actually in the same kind of channel. It's at the top of the trains now, but it had a really good earnings report this week. I looked at its PE, and its forward PE is 6. And the interesting thing about GE, even though they went through a bankruptcy process and eliminated a lot of their debt is double of their market cap. So that's one of the worst things about about GM. And I looked at the earnings estimates for GM, and they're only growing from this year to next year only 3%. And this way, if you divide these two, that's 3%, and then 15% after that. But they don't give guidance past 2025. So their PE is only 6, and if they're growing like 10%, if you take 3 and buy 15, maybe it's 10% they're growing, then it's they're on sale. They're 0.67 PEG ratio. So the only problem with this company is the cars. Typically, the car companies aren't treated very well. They have a PE, the lowest PE in the whole stock market, of 6. They're not growing a whole lot, of maybe 6 to 10%, and they have all this competition. I don't know. It's not that. I think this right here, this was unexpected. It was they had a surprise 20% better than expected this time, but this is kind of flat, and the earnings aren't that great. So it's better than Ford, definitely better than Ford, but it's still not good enough for me to be interested in it. All right. So let me see. Okay, so the other things are we have, this is a February, so we don't expect a whole lot. This is one of the worst months of the year, primarily because there's nothing exciting going on in February. And then we look forward to March, April, May, which are 3 of the best months of the year. So, and then we get into the summer doldrums. The reason why we go over this every week is you gotta prepare yourself for the ups and downs of the stock market. And if we can somehow predict what's going to happen, we can better time our investments. And the worst thing to do is to sell out whenever stock markets are going down, and when it's going up, start buying again, because that's a good way to lose your money. Okay, so we do have 6 minutes left, so that's a good time to review what makes a good stock for a growth stock. And these are stocks similar to the ones held by these mutual funds that we follow every 3 months. Stocks that are, they're pretty much, their earnings are going up in a straight line. Whenever you look at earnings estimates, you got to compare quarter to quarter. These look, jagged, but if you compare the third quarter of one year to the third quarter of the other year, it should be going up in a straight line, because demand for a product is different in different quarters. So let me see. So we like to see total debt. It can't be a lot compared to market cap. Now we saw GM had double the debt of its market cap. That means whenever the interest rates go up, it's going to pay more to service that debt, and they won't make as much. We have return on equity is something we look at. We like it greater than 12. Profit margin, greater than 12. Market cap, we like bigger companies because they're more consistent. Let me see, the growth rate we like to have greater than 10. The other thing I want to show Wait, hold on. Okay. All right, so the other things, okay, that is basically everything. Let's do one more thing. We didn't look at our top 10 stocks going up and down today, and why. Let's look at the S&P. Okay, I don't know anything about Clorox. You see a lot of everything that was working last year is working again today. This is a lot of drug stocks in the top performers. The ones doing the worst are the tech stocks. So it seems like on a daily basis we're flipping between, what worked good last year, what didn't work good last year. So let me see. Most of these are conservative stocks, and pay dividends. The one's going down the most. No commonality there. Let's look at the NASDAQ stocks going up and down the most. A lot of these are earnings based. Stocks that have good earnings, they're up at the top, and bad earnings down at the bottom. We have the high PE stocks. A lot of these top decliners are high PE ratios. So that's an example of, in a higher interest rate environment, the high PE ratio stocks go down. See. I think earnings reports are what's driving a lot of this activity. So Starbucks just reported, and if you report, good earnings projections, then your stock goes up a lot. All right, so let's look at the Dow. Why Apple's going up, I don't know. They had bad earnings report. We see 3M is one of the top decliners. They have that lawsuit we were just talking about. Perhaps that'll never go away, and maybe they might go bankrupt. I don't know. I try to stay away from those companies, and let's see if J&J ends up being on a top decliner someday due to the exposure they have to the talcum powder lawsuit. It's not here yet, but I don't know. That's kind of scary. Okay, so almost all these are like high dividend paying stocks, the ones that are going down the most. Okay, so today's like a conservative day. Let's look at what the S&P is doing right now. It's down 1%. I'm surprised it isn't down more. Okay, look at that. Okay. Let's look at the S&P again. Okay, we looked this up. Look really close. You can see we've actually started a new channel here. We have higher highs, higher lows, and we've hit the top of this channel, this new channel. We're going up. So there's a very good chance if we're going to follow this, we could go down to here and start this zigzag up. Let's see if that pattern, if by next week we're down to here, and if we bounce off of that, we have a new pattern, and we can see higher highs. for basically every stock, because almost every stock follows the S&P. Let's look at a couple more things. Let's look at the stochastics for a lot of these stocks we're following and indexes. Okay, so we can see that a lot of the stocks and indexes they've broken out of a long-term downtrend. That doesn't mean that we can't go back down to here. It just means that the current trend is, higher highs in this small little window. Okay, we have a lot that are starting to break out of these channels. You can see communication sector. Look at this. It went down for 2 years straight, and all of a sudden we're starting to see all the telecom stocks doing good. So we had a little uptrend there, and they broke out of this downtrend. Healthcare it looks like it's going to be flat this year, and it's going to be in this trading range. So everything that was going up last year, it's going to be sideways this year, it seems. But it's a conservative. This works in a recessionary environment because people still buy drugs in bad economic times. Let's look at, okay, we have a lot of sideways patterns right now. And okay, this is energy. Energy is one of the only sectors that it's still from last year, still in an uptrend. And we're at the bottom end of that downtrend right now. If we break through this, the uptrend in energy is over. So let's see. This is uranium. We saw Dan Niles was talking about uranium as one of his favorite ETFs. So we're going to follow this. Right now it's in a trading range like the dividend stocks. But we're following it just because he mentioned it. For stocks, almost every stock that we're following is kind of broken out of the downtrend and started a new uptrend. So you can see Alphabet. See Amazon. They probably went back down to here. So maybe it's a slower recovery for Amazon. Apple, you can see it's starting to break out, and today it's continuing this little uptrend. AT&T. Okay, it's kind of sideways. I think all the dividend-paying stocks and drug stocks are going to be sideways this year because that's the pattern it was last year, and it's something to work in a good environment like this. You see. Yeah. Okay, I think I'm running out of time. Let's see if there's anything more interesting. Oh, Meta went up 24% on Wednesday. So looks like they're in an uptrend here. So they're higher highs, higher lows. So it's following a lot of these stocks that are breaking out of the downtrend. Microsoft, it broke out of that a little bit too. I didn't mention that. Pepsi is one of the stocks that worked really good last year because they raised their prices, and they had strong demand. And they're at the bottom of their range now because people were getting more into tech stocks in the first month of this year. So people sold off what worked last year. But chances are they're still going to be doing good this year, and they're still in an uptrend. You see. All right, so you can see a lot of uptrends starting here. And, okay. I think I've used up all my time. Are there any questions anyone has?